people are unemployed, there is no money. The whole consumer cycle, the consumer credit cycle, that doesn't look good, to be honest. And so I think the fall is going to be complicated.
Chamath, has the soft landing been secured?
I mean, it's pretty incredible, actually, but it looks like there's a really good chance that it has. I think the bigger question, though, is if we are on the verge of a real contraction in the economy. And I think there's been enough people that have warned. You have to remember, like, even though the stock market for 7 companies is hitting all-time highs, the stock market for every other company that isn't those 7 companies have not. And that really is about just the broad-based demand in the economy. So yeah, I think that inflation is contracting, but it could be contracting for a combination of reasons. One is because we have had high rates for a long time, but the other part is now people are unemployed, there is no money. And the question is whether you have some sort of contraction economically that is measured by a recession or not. I think that's a really big question. What happens in the next couple of quarters? Do we have a little mini recession or not?
I think the market's priced in a lot of the expectation already. If you look at the PE chart on the S&P 500 going back 5 years, you can see that we peaked out, obviously, in 2020, 2021, where we had a big boom with all the stimulus money coming in and all the money found its way into the markets during the end of the ZIRP era. And then there was the slow wind down as we started to hike rates, and then rate hikes peaked. And now, despite the fact that rate hikes have stopped and there have been conversations about when the reversal will happen, the market's already started to price in that reversal. So with respect to like market valuations, we have still seen a rather significant increase in the PE ratio across the S&P 500. Now, to Chamath's point, a large percentage of that is contributed to by the top 7 tech companies that are driving that ratio inflation. But a lot of the market makers have already started to take action, expecting the rate cuts to come in at 90% plus likelihood of rate cuts happening this year. So I don't know how much market action we will see, but there has been a lot of conversation from DC about the Fed should reset expectations on inflation from 2 to 3%. And if they did that, that becomes the new normal. And we're never going to get back to 2%, at least in this current kind of era. The Jerome Powell mandate of 2% inflation may be an expectation that cannot be met given the amount of stimulus that went into the economy during COVID, that it could take a decade to earn its way out. As a result, we will not see a normalized contraction of that capital coming out of the markets in a way that will get us back down to 2% inflation for the time being. And I just saw a presentation by a bunch of food company executives recently, and they took 13 to 15% price hikes last year. But the reality is that inflation is not just in the US, but around the world, and it affects the US markets as well, because a lot of US companies have had to raise prices because of their dependence on labor and materials and commodities from other countries that are inflating. And because of the way that the globalized economy works today, the inflation around the world is going to continue to buoy inflation in the US, even if we get our house in order. It's very unlikely that we get back to a 2-handle, at least in this kind of era. And as a result, you'll probably see the market kind of assume that we're going to be at a 3% kind of inflation level for quite some time.
It's very interesting, the obsession with the 2. The 2% handle and this target came from the Reserve Bank of New Zealand, this guy, Roger Douglas, Minister of Finance. And he came up with it because they just asked him, like, well, what's a healthy one? And he came up with that, and then everybody adopted it.
The Fed's mistake was just waiting way too long to react to the inflation. And they didn't just wait 9 months after the first inflation print came in that was too high before they started raising rates. They continued QE for 6 more months. So when you talk about all this stimulus that's still in the economy that they can't seem to get rid of, a lot of that was created by the Fed's QE in the second half of 2021. That should never have happened. Since then, they did what they had to do, which is they increased rates to solve inflation. That's what you do. And yes, it does seem to be working, but we still have inflation being persistently high at 3%. And so now, like Freeberg's saying, they're trying to change the goalpost to somehow normalize 3%. We should just understand that what that means is permanently higher interest rates, because the Fed has to offer, under normal circumstances, has to offer a return above the rate of inflation. So whatever that return is, 1%, 2%, you stack that on top of the inflation rate. So in other words, let's say the Fed wanted to target a 2% real return. That means that the interest rate would be 5% with the 3% rate of inflation. Whereas if inflation can be managed down to 2%, you would have a 4% interest rate. And that persistently, if we're talking permanently higher interest rate, will create a drag on the economy, because lower interest rates create more investment. They reduce the hurdle rates to take risk, whereas higher interest rates, as we've seen, create drag on equities and drag on investments. So if they redefine the inflation rate to 3 instead of 2, there will be long-term consequences from that. That is not a free thing to do.
Yeah.
So that would be like one part of the answer. The other thing is just, look, inflation going from 3.1 to 3.0 is positive. It's good news, better than it going from 3.1 to 3.2. But we're talking about 0.1%. And I just think people get a little too excited reading into these prints when these are not huge changes in numbers. I do think that once the inflation rate starts with a 2 handle, that psychologically, I think will be a big change for people.
Psychology has so much to do with this. I thought I was doing a little research on it, why it's so contentious and there's so much of a lack of consensus about it. This is basically a psychological phenomenon called partisan economic perception. And this has been studied for some time. And what's really interesting about it is it shows what percentage of people who are Democrats and Republicans here in the United States of America say the economy is good. And if you look at Clinton, and he got to be president at the helm during the internet revolution and this incredible economic boom, he was obviously so centrist, right? He appealed to both sides of the aisle, and you had this very tight consensus that the economy was good. Democrats were maybe 3 or 4 percentage points above Republicans in that perception. And then Bush came in, and all of a sudden, Democrats hated Bush so much that they perceived the same economy. 2000, obviously have the dot-com bust there. So they both went down in unison, especially after the Great Recession. But you have this disparity that comes up, Chamath, where you have 25 points between how they perceive it. Obama, obviously, Democrats were incredibly enthusiastic about Obama, effusive even, but Republicans hated him with a passion, right? I mean, that was really when Fox News started to get cooking. And then you look at Trump, same exact phenomenon. It flips. Under Trump, 80% of Republicans think, oh, the economy is good. And then Democrats say it's not good. And that plummets and you get this big dispersion. There are 2 moments in time, Freeberg, or 3, when you start to see the consensus get tighter, and that's during a crash. So there's a dot-com crash, great financial crisis, and an election, that's a very good point, actually, I didn't notice that. And then also during the pandemic. So you have 3.
Yeah, this is a great chart.
Looking at this, I think it explains so much of the tension in the country that we can't even agree on, hey, is the economy good? Everything is perceived through your partisan lens. What's your takeaway from this?
At the end of the day, if people feel like they're progressing, they feel happier. If they feel like they're not progressing, they're unhappy, regardless of their absolute state. I think that there's some studies that show that if income growth is not roughly 10% a year, you get an unhappiness indicator. And then there are other associations with that. Like, am I improving the size of my house? Am I able to buy a new car? Am I able to progress in my career and make more money? All these factors kind of play in. And much of this ends up being buoyed by the political ideology of the candidate that's in the office and how they are popularizing what they are doing to help you progress, even if you are or are not actually progressing. So then people hear the political leadership say, this is what we're doing. You associate that as being positive or negative. If you're a Republican or you're a Democrat, you associate it as one or the other. And so you have this perception of progression without actually having economic progression be tied to it. So the reality is it gets decoupled. Much of the inflation, I think grocery prices are up 30+%. The more globalized the businesses are that are providing the goods or services to us, the more likely they are to need to hike prices to make up for the inflationary cost structure in their business because of their global presence.
There was an article in Bloomberg. People have been tracking the S&P 500 index versus the equal weighted index. So when you calculate the S&P 500 index, you weight it for the market cap. So the top 7 or 8 companies obviously get a lot more weight in it. And so they look at the spread between that index and an equal weighted index where every 500 companies are, the 500 companies are each equal. And what's interesting is the spread right now is the most extreme since March of 2000, right before the dot-com crash.
Jesus Christ. Thanks, Chamath.
Well, this is Bloomberg's data, so I'm just repeating it. I read that article, but
that's incredible.
We could be at the end of just an enormous hype cycle here where we have to contract the equity market. That's probably not a bad thing, by the way, because as Zach said, one of the things that you have to do is I think you have to underwrite to a rate of return. And right now, nobody knows really what to do because valuations would tell you that you should price to the low end, but then it's not really clear what the risk-free rate of return should be. Everybody's just sort of like they're shrugging and their arms are in the air and nobody knows what to do. So if you really want to get the economy moving at some point, you're going to have to reset something. You're going to have to reset rates, or you're going to have to set the equity risk premium in the stock market. You're going to have to reset people's expectations around what is actually happening in the economy. And right now we're in this limbo where none of those things have been decided. But there are all of these weird moments, like data points that you could use to kind of justify your bias, quite honestly. But the point is that I think there's a lot of question marks right now, not a lot of answers.
Sachs, what's your take on this AI bubble? How much of this boom that we're seeing in the stock market is this AI bubble?
Well, a lot of the boom is driven by these AI stocks, notably NVIDIA. I mean, if you take out the AI stocks, I'm not sure the market is up, or maybe it's up a little bit. I mean, a huge part of the gain is from these, I don't know, top 5, top 7 tech stocks. Is it a bubble? I think that's going a little too far. I mean, I personally think the AI wave is real. I think the question is whether the level of investment that we're seeing going into cloud service infrastructure is sustainable. There's a huge build out happening right now, many, many billions of dollars building out these new cloud service centers or cloud infrastructure. Data centers based on GPUs instead of CPUs. And I think it's a good question about whether that's sustainable. I do think that one of the things that's going on is that the chips are really expensive. I mean, these GPUs from NVIDIA, what they're like $30,000 per GPU.
For an H100.
Right. And part of the reason for that is the scarcity. They haven't been able to produce as much as there's demand for, and so they're commanding a premium right now. In any event, they're very expensive, and so it's very expensive to build out this new infrastructure. I do think that over time, the price of these chips just has to come down. It just doesn't make sense that they'd be so expensive. Just as production increases and they don't have this rate limit on the supply, then I think the price should come down and the cost of this infrastructure should normalize a bit.
The chicken is coming home to roost, because if you do not start seeing revenue flow to the bottom line of these companies that are spending $26 billion a quarter, the market cap of NVIDIA is not what the market cap of NVIDIA should be. And all of these other companies are going to get punished for spending this kind of money. Where are all these newfangled things that we're supposed to see that justifies $100 billion of chip spend a year, $200 billion of energy spend, $100 billion of all this other stuff? We're now spending $750 billion. This is on the order of a national transfer payment. And we've seen nothing to show for it except that you can mimic somebody's voice. It doesn't all hang together yet.
You know, the general statement might be made that perhaps the first AI mini bubble is bursting a bit, and particularly with respect to the accelerated expectations that public market investors had for public market technology stocks, that perhaps now is the time for a bit of a reckoning, that perhaps this isn't going to happen at the same margin level or the pace that folks had modeled.
Correct.
And this is going to cause a bit of a setback.
I think that's what's likely to happen. I'm much more bullish than you guys about this investment that's being made. Remember that when the internet got started in the 90s, it was via dial-up. I mean, you literally had to have a modem and you would dial up the internet, and it was incredibly slow. Photo sharing didn't even work, so social networking wasn't possible. And basically what happened next was that the telecom companies spent a ton of money building out broadband, and people started upgrading to broadband. Then we had the dot-com crash. Everyone thought that the telecom companies had wasted billions of dollars investing in all this broadband infrastructure. And it turned out that no, they were right to do that. It just took a while for that to get used. This is a pretty common pattern with technological revolutions, is that you can have a bubble in the short term, but then it gets justified in the mid to long term. The build out of the railroads in the United States is another example of this. We had huge railroad bubbles, but it turned out that that investment was all worthwhile. So I tend to think that's what's going to happen with AI. I do think that there's already enough, let's call it realness to the applications. Where I think Chamath has a point is that these big tech companies are not building out all of this infrastructure because they've modeled out the ROI and it's extremely positive. They're doing it because it's an arms race. It's so strategic right now to have these AI capabilities and to power the expected next generation of AI apps. They can't afford to let one of their competitors have that. They have to compete. So they're all in an arms race with each other, bidding up the cost of these GPUs because they have to have that supply.
It's like nukes. It's like nukes. You never use them. You build them out. It might be the good comparison.
I mean, I think they're going to use them, but yeah, I mean, the point is that it's a zero-sum game. And if I let you have this GPU, I have one less GPU to use.
The stock market just had its worst day since 2020. The NASDAQ, which is the most tech-heavy, fell. A bunch of the Magnificent Seven companies were in the red. But you got to put this in context. NASDAQ and S&P still up around 15% for the first half of the year. Record-setting territory, obviously, if that holds up or increases. There's a lot of theories about this that people are rotating out of the Mag 7 tech stocks, which were a place that maybe got a little overheated with the AI bubble. Here's the top gainers. Over the last 6 months, S&P Financials up 11, S&P Energy 9, S&P Materials 9% as well. Broader index up 11, as we said. Tesla dropped 12% after missing on earnings, but they had a massive run up earlier this year. Google dropped 5%. I guess YouTube was what most people pointed to. Their revenue came in lower than expected, so maybe some softness in the advertising market, which would then correlate with consumers. Nvidia down 7%, Meta down 6%. Chamath, any thoughts here on what we're saying? You talked a lot about the consumer weakening on an episode about 6 weeks ago, I believe. So is this just the manifestation of that prediction you made?
Not this specific thing. I think that when you see a broad-based set of revenue misses, that will kind of mean that the consumer is really under pressure. I still think that that's more in the fall, but we're headed in that direction. I think what happened here is that the market is just priced to perfection, and all of a sudden we had all kinds of volatility. You had the former president almost assassinated. You have the current sitting president resign. You have a somewhat convoluted process to pick who replaced him that at a minimum was opaque. And all of these things create doubt and anxiety in the people that own financial assets. And so if you saw the volatility index, the VIX, that has spiked. And so whenever you see that stuff happen, people go risk off, right? And when you go risk off, what do you sell? You sell the things that are deepest in the money, where you think that they probably don't have that much more room to run. And that was the Mag 7. And so what you actually saw was a huge rotation out of those companies into everything but those 7 names. And I think that that's a pretty reasonable thing to do. So I think we're in the part of the cycle where people are getting a little bit more sober and risk managing. We're also in the summer where a lot more vacation is taken, which how it manifests is that people tend to be, frankly, more risk off and be more liquid because a lot of people are in and out of the office. And I think the real setup is for what happens in September. Maybe there's a cut, which will help. Maybe there isn't, which won't help. And then the whole consumer cycle, the consumer credit cycle, that doesn't look good, to be honest. And so I think the fall's going to be complicated.
To wrap things up, Chamath's insights highlight the importance of aligning investment strategies with long-term value creation rather than short-term gains. His emphasis on resilience and understanding market dynamics can be a game changer for those willing to dig deeper into the fundamentals. Whether you're navigating the volatile tech landscape or exploring new sectors, his approach offers a roadmap to thoughtful, impactful investing. It's about staying curious, informed, and always looking beyond the immediate noise.